Greetings, everyone. I'm David Darst, here for a recap of the month of February. Thank you for joining us. After the tremendously strong, powerful move upward for financial asset prices, stocks up, bond yields down in the month of January. For example, the S&P 500 was up 6.2% in the month of January. It gave some ground in February. It was down 1.5% to 2%, so it's now up 4.5% as of the end of February. NASDAQ was up 10.7% in the month of January. For the month of February, they were basically flat. Then you had the Russell 2000 index of the small and mid-cap stocks, 9.7% in the month of January, and it was down 1.4% in the month of February. So you're up about 6.8, something like that, percent. Gold was up 6%. Interest rates down, gold up for the month of January. Gold basically gave back all of that gain in the month of February to basically be flat to down slightly, a couple of tenths of a percent at the end of February. Oil was down 1.7% in the month of January. Oil was basically almost unchanged. It was up less than 1%, so it's basically down almost 1% as of the end of the month of February. Now, the volatility VIX index is based on options prices. It basically traded in a narrow range between 18 and 22 throughout the month of February. So all of this retreating in asset prices happened in a non-super volatile environment. It just gave ground. That's all it did. Interest rates, the 2-year Treasury closed the month of February right at 466. That is up 57 basis points from 409 on February 1st. Remember, February 1st was the day of the Fed meeting, and everyone thought after Chair Powell spoke at the press conference, okay, the Fed's almost done tightening. The economy's slowing just right, a Goldilocks kind of situation and scenario. The 10-year Treasury was 339 at the end of February. It had risen also dramatically by 47 basis points to 388. Treasury bills were 466, and they were up less because they were already high to begin with. They were up only 16 basis points to 484. The inversion, we've talked about this many months, the inversion between the 2-year and the 10-year, the 2-year minus the 10-year, 78 basis points negative at the end of February. At the end of January, it was 70 basis points. So it got even more negative in the month of February. Now, what are the reasons? There were four basically pretty big reasons. Number one, you had inflation. It came in much higher than people were expecting it to come in. Consumer prices, producer prices, personal consumption expenditures, they were released on Friday the 24th. They were also not only the headline number, but the core number. And let me say on inflation, 1 year ago, we had the invasion of Ukraine and the Ukraine conflict beginning. And month after month last year, you had high inflation numbers. So let me just say, as we go through the rest of this year, we're going to be comparing against those high inflation numbers. So your year-over-year number will not be that bad. It will actually start slowing down. But the month-over-month number is what you have to keep looking at. So reason one that you had this big turnaround in February is high inflation, higher than expected. Reason two, the economy was stronger than expected. The jobs market was up 517,000 jobs added in the month of January. Surprised everyone. Unemployment, 3.4%, a 54-year low. You have to go all the way back to the late 60s to get unemployment that low. The retail sales, quite strong, okay? So, and then you got reason number three, the Fed rhetoric. You had Loretta Mester. She's one of the regional Federal Reserve Bank presidents, okay, Cleveland. You had James Bullard. You have him. He's the president of the Federal Reserve Bank of St. Louis. Both of them were saying, as well as other people, maybe we need 50 basis points at the March 21st, 22nd FOMC meeting. Everybody was expecting 25 basis points and the Fed to kind of go soft from here on. After the strong economy, strong inflation numbers, that's why you have this, and the Fed rhetoric was much more hawkish. That's why you had this retreat in the month of February. The fourth reason is, as you know, many of the people who were short stocks as they went into the end of the year, these are institutions, hedge funds, and others, they rushed to cover, and that caused prices to rise quite a bit in the month of January, and that began to play out, and that wasn't there to the same degree in February. The second part of the January rise, individuals received money for their retirements. They received money from their bonuses, from their employment situation, and they put that money, a lot of them put some of that money into the stock market. That's why you also had this. That also begins to diminish, it begins to moderate as you get on into February. That's a fourth reason. But the big reasons were the high inflation and the strong economy. What's our recession forecast right now? There are several things arguing that we would have a very mild recession, or maybe no landing, not much of a recession at all. And there's others that arguing that we'll get a recession later on this year. That's my personal feeling, that we will get a recession. You've got the inverted yield curve. It's a great predictor of recessions. You've got lead economic indicators. They have been down 11 months in a row. Last 6 months combined of the lead economic indicators is worse than the previous 6 months. So it's been deteriorating even further. You have the money supply. You remember a year ago, it was growing well over 20%. Now it's negative year-over-year growth, M2. You have lagged effect of the Fed tightening that we did last year. Okay, we've already hiked interest rates several times, 75 basis points, 50 basis points on several occasions last year. So you've got the lagged effect of that monetary tightening continuing to filter through the economy. ISM manufacturing number was moved back into contraction. The services went into contraction, but then it went into expansion. So it's been very, very mixed. And existing home sales have been down now for 12 months in a row. So these are some of the things arguing, and that's why I think we could easily have a recession. Some people say no, David. They say there's a good chance that we'll have either a mild, very mild, or no recession. You've got financial conditions. They're pretty good. You have the jobs, 53-year low in unemployment, okay? 3.4% unemployment rate. Retail sales, very strong, 3% in the month of January. The GDP now forecast of the Atlanta Fed for the first quarter. Now, this is just right here at the 24th of February. It was last Friday, the 24th of February. They are predicting that it would be, for the first quarter, 2.7%. And then the last one, of course, is the Social Security checks. Social Security checks this year are going to increase by 8.7%. It's one of the largest increases year over year that we've ever had in Social Security. And that goes into people to help them spend. So these are the things that people use as arguments that we're not going to have much of a recession. You could also say the other two Feds, the oil's down and the dollar's down. And when last year we were talking about the oil being a Fed and the dollar being a Fed, since they were restricted. Those have come down, and that basically helps our exports, the dollar being down. So it is a positive thing, and oil puts more money in people's pockets to spend. Now, what do we need to see to tell you that we are basically out of the woods, and that we can go into more of a risk-on investment posture? One, you need to see the economy, basically the growth, not rolling over hard, okay? Slowing down would be good, but not rolling over hard. The second thing is the Fed to give indication that they're almost done with the interest rate increases. I believe you're going to have you got a May 2nd, 3rd meeting. You've got the March a 21st, 22nd meeting, and then you got June 13th, 14th. Those are the next three meetings. A month ago, I would have said we'll have 225 basis points. Now you're having Fed officials talking about maybe 50 basis points at one of those meetings. You're having people talking about 25 basis points at all three of those meetings. So the second thing for me to come here and tell you that we're almost done would be the economy to slow down but not roll over hard. And secondly, it looked for the Fed to be giving indications that they are done raising interest rates. They can keep them high, but no more raises. Now, for me to tell you we have made a significant bottom in the stock market, you need the three C's. You need capitulation. I don't think we've ever had people panicking and throwing in the towel and selling all their stocks. I just don't think we've had people abandoning financial assets. The second thing is you want to see conviction. And all of this move, January and February, were made on very light trading volume. This has not been a heavy conviction move, either up in January or retreating somewhat in February. It's been not a highly convicted moves. And the third one is correlation, and that's where you see volatility going up, and the stock market basically acting in a classical fashion, going down. For those three things, for me to call an actual bottom. Now, our positioning. You want to have some liquidity. You're getting on Treasury bills 4.84%. Come on, 4.84%. That's a nice yield while you wait. So keep liquidity. Secondly, dollar cost averaging. If you're going to put some money into risk assets, move it in slowly on a time sequence basis. Don't throw it all in at once. That's number two. Number three, diversification. We've said 30% growth, 40% in value, which is financials, it's other low PE stocks, okay? And it's defensive stocks. Defensive is healthcare, defensive is consumer staples, and defensive is utilities. Those are higher priced than the value stocks. Their multiples are higher, so you want to basically take your time on those, and then 30% growth. 30% growth, 40% value, 30% defensive. And we think you should have a healthy allocation, depending on your risk profile, to alternative assets. You're talking about private equity, private credit, and private real estate. With that, we thank you and we wish you a great start to the month of March.